Yeah, good afternoon, ladies and gentlemen. Thank you for joining us for the next in the Admiral Markets webinar series on Trading Spotlight. Today, as you can see from the title slide, we are here to talk about the inside bar candlestick pattern. And my name's Paul Wallace, and I will be the leader today for our webinar session. So what are we going to talk about today, ladies and gentlemen? I'm going to talk about what actually is an inside bar. I appreciate that we have a wide range of experience who join us for our sessions, some very, very new, some very experienced, but hopefully what we'll do is be able to talk about, how an inside bar is formed and where and how they set up, and also how can a trader use them, okay? How can you utilize them in your own sort of trading arsenal of tactics? And make you a little bit aware of what to be aware of when you're using them in your own trading. And if there's time at the end, we'll look to try and have a quick checkout on the live market. So thank you for joining us. Okay, if you're watching this on YouTube, all right, then please by all means subscribe and also sort of comment. Okay, send us questions. We'll be very happy to engage with you. Those of you who are here with us, joining us for the live session, as I said, by all means, we're very welcome to take questions from you. We love them. All right, so please feel free to fire them away. And as I said, hopefully we'll have a little bit of time at the end of our session here to be able to sort of check out them on live markets. So without ado, what we can do is we can push on. For those of you who don't know me, my name is Paul Wallace. I'm a trader and a coach and an analyst, and I'm our webinar spokesperson for today. So my background from trading is, I've traded for many years, okay, and have traded through not only for myself, but also working for funds and trading for high net worth clients. My own trading, primarily, I sort of look at FX indices and commodities. And for my sort of swing and position trades, I'm just looking to sort of trade with dominant trends. And my intraday trading is all about mean reversion. So very simple, but hopefully over this series of sessions, you'll get to have a little bit more of an idea of how I look to trade myself. We're also here, as I said, this is part of the Admiral Markets webinar series. As you can see there, Admiral Markets are an FX and CFD broker. You have access to over 8,000 financial instruments. We've got offices in 20 plus countries. We're licensed and regulated across the globe, and we offer a very competitive spreads there on very popular trading instruments like Euro, Dollar, and the DAX 30. And we also offer the MT4 and MT5 trading platform with the Admiral Market Supreme Edition, which is an excellent suite of tools and well worth checking out for you to help you with your own trading. So, ladies and gentlemen, let's kick into talking about what an inside bar candlestick pattern is. So, throughout the Trading Spotlight series, we're going to be talking about various different candlestick patterns. There are various different styles of price action trading, but the inside bar is quite a simple setup. It's quite an easy and almost visual setup as well. But as the name implies, an inside bar is formed when the high and the low of the bar is fully within the range of the preceding bar. Sometimes you'll hear them sort of referred to as mother bars or kangaroo bars, okay, which is probably pretty sort of self-explanatory. But as always, if we just use a little bit of our tool here, okay, we can draw in. As I said, this is the inside bar here, and what we're actually looking for is to ensure that the high and the low, okay, of this bar is within the range of the preceding bar. And I just want to be very clear in this. When I talk about inside bars, I'm including the highs and the lows, which includes the wicks. Sometimes people don't, but really for an inside bar, the entire range of that candlestick, okay, should be within the range of the preceding bar. And as I said, sometimes the bar before can be sometimes called the mother bar, okay. Sometimes, as I said, it'll be called kangaroo bar because it's like a there's like a kangaroo carrying a sort of a baby handle within its pouch. It doesn't really matter too much how you wish to refer to it. You can call it whatever you particularly like. Sometimes in Japanese they'll call it harami. There's lots of different names. It's more about understanding what actually has to happen to go to sort of create an inside bar. And as I say, that is really the range. The high and the low must be within the range of the preceding bar. Okay, it doesn't it doesn't matter if it goes out a tick or two, that that's thinking that, well, that's okay. No, it doesn't. Okay, it has to be within the range. That's what's brutally clear. Okay, when it comes to an inside bar. Now, how I like to define it is, or consider it, is to think of it as, that the markets, even in the modern age with tech and algos, is that the markets are still made up of human interaction, right? And it is a bit like an inside bar is a reflection of the markets acting like a human. As in, your markets, they surge and they rest and they surge again. A bit like humans, okay? Humans, you work, okay, or you surge, then you have a rest period, and then you get ready to surge again. And the inside bar is it's like the rest period, okay? There's been a bit of a surge. The inside bar is the rest, and what we're looking to do is to position ourselves to try and catch the next surge. That's what we're actually looking for. So here's some examples that you can look at. Okay, as I said, the important part is, all right, we can see here, we've got ticks here, okay, is that the important part is, as I say, is that the range, the high and the low of the bar is clearly within, okay, it's clearly within the range of the preceding bar, okay. That is what defines it as an inside bar. As you can see here, okay, this is not an inside bar because actually the wick, okay, we can see the wick breaks out above the high of the preceding bar. That is not an inside bar, okay? Some people try to sort of just talk about basically the actual bodies of the candles, and they would say, oh, well, actually, Paul, that's an inside bar because the body, okay, is within the body of the preceding bar. And personally, I don't buy that, okay? There's a reason there's a high and a low. It means there's trading has gone on there. And, in this particular case, all right, okay, the high of that candle, right, was higher than the high of the bar preceding, and that is actually what's important, okay, all right? These inside bars, the range is all within the preceding bar. That is the key element, ladies and gentlemen. So Sandra just sort of asked that, is there any particular time frame recommended to use inside bar pattern? Thank you for that, Sandra. Well, actually, with all of these sort of candlestick patterns and price action elements that I'm going to be sharing with you during my part of the Trading Spotlight series. What I'm very, very big on is the setups being time frame and instrument agnostic. And what I mean by that is that, the sort of setup should be able to work on any instrument and on any time frame. So I appreciate that we have some traders who join us who will be, let's say, aggressive intraday traders on the 5-minute chart. And there'll be other traders who might be swing traders trading on the, let's say the 1 hour, the 4 hour, and the daily. And then we might actually even have position traders who are trading like weekly and monthly charts, okay? So I appreciate we have, as I said, a broad experience, but also a broad interest in terms of how to engage with markets. The important thing is that inside bars, you will see that invariably inside bars, they show up across all time frames from 1 minute charts to 1 month charts, okay? They will always show up. It's about actually understanding the sort of within which context does it appear. That's what starts to sort of make the difference between identifying, a good inside bar setup over as, let's say, a sort of a mediocre one. And hopefully over the next few slides, we'll be able to give you a little bit of insight on how to do that. So yeah, this is just it's an example of a chart here. Again, nothing really too out of the ordinary. Just more a case of just understanding that we see lots of inside bars. Okay, inside bars. Once you start looking for them, you'll start finding that they appear much more often than you might have considered. And as I said, they're there, we'll see them, they're all about the place. It is realistically about just trying to be able to recognize what's the context within which they are showing up. Where and when do we take an interest in them as possible trade setups? over the next few slides. Okay, that's what we're actually going to try and show you to give you some help and support and some education about how you can find these opportunities yourself. So, what we see with when it comes to inside bars is that inside bars can be traded as either continuation or reversal patterns. If I can give you a little bit of let's say a trader tip, is that if you wish to trade them as a pure reversal, then it should be at the end of a trend at a particular level of support resistance as part of a confluence of events. All right, so it's just what I would say about any sort of one-off candlestick pattern is that just trading it because there is that candlestick pattern has occurred, whether it be an inside bar or an engulfing bar, a pin bar, okay, a doji, a spinning top, etc., is that you can trade them just on their own, but what happens is they have greater success or greater chance of success when you use it as part of a confluence of events. And that's where, as I said, if you wish to trade them as part of a pure reversal, then as I said, it should be at at the end of a trend at a level of support resistance, and maybe with 2 or 3 things all coming together at that one particular time and place. That's what will actually help you a good deal more. So, here's just a little bit of an example. This is, just, this is the Kiwi yen. Okay, this is a weekly chart. As I said, I wanted to be able to show you that there are, they show up across all sorts of time frames. And what we can see here is that on this particular example, if I just get my pen here just to help, we can see at this first example here is that, we had, an inside bar here, okay, a bearish inside bar that happened after a bit of a long run up. It happened as part of an M pattern, a double top pattern, which was also at the 200 period moving average level, which was acting as dynamic resistance. So we can see that as price had moved up, that inside bar was kind of, the market was having a rest before it had its particular surge downwards. Okay, so remember what I was just saying in the slide before. Okay, if you're going to use it as part of a reversal, it should be, at a level of support and resistance, and maybe with a confluence of events. In this particular case, we had a double top reversal pattern. Okay, so there was, as I said, there was a confluence of events. There was, 3 or 4 things all coming together at one time and place that was likely to give you a higher probability of success, and that's what we're aiming for. And here you can see that actually, as price sort of falls down, price actually hits the area. This is the red moving average, is the 50 period moving average. It's been in a long downtrend, okay? And we can actually see that once again, we had a little bit of an inside bar there, okay, as part of that, before price actually drifted its way up. So, as I said, you can use them as a reversal pattern. They are, they do have validity there, but as I said, it's very important to have it, to see it as part of a confluence of events. That's where you're most likely to have any sort of version of success in terms of using them as a reversal pattern. So, what can help you with that is, whether you want to trade them as either a continuation or reversal. All right, personally, I prefer to trade them as part of a pullback in an existing trend. That's how I like it. I'm going to show you how I like to sort of show them, or how I like to sort of engage with them. But what I want to see is, I want to see it as part of a pullback in an existing trend. So in this particular case, price has been going down. Price actually has a pullback. Okay, we've had a surge. Okay, now we're having a rest, and the inside bar is the kind of the end of that rest before the next surge occurs. And that's what we're trying to set up and be ready and prepared to sort of to make some use of that. If depending upon, I said, on your time frames, if you're looking for them on weekly and daily, maybe even monthly, well, then actually sometimes what you can do is you can step down a time frame and utilize, so let's say, a 4-hour chart to be able to execute and manage in terms of where you set your entry and where you set your stop loss. And what you would also want to be aware of, or sort of to take into consideration, especially on the sort of bigger time frames, is decide your entry, right? Whether it's going to be on the entry of the break of the bar. So in this case, it would be in the terms of the break of the inside bar, or whether it is on the break of the range, okay, break of the range from the mother bar, all right. And the reason I sort of say that is, well, I appreciate that, you know, we have some traders here who are quite aggressive and would be very happy to sort of just trade the breakout of the low of that bar because they expect the price to move down. Other people would sooner sort of just take a little bit of a little less risk, a bit more risk averse, and would actually just wait for the body to basically to track through the sort of the low of the mother bar. What we can do is, you know, what hopefully doing that second one is that sometimes that may allow sort of to prevent a false breakout, because no trading system is 100% accurate. What you might see is price trading through and then coming back up to sort of to take you out because it wants to do a particular false breakout. So you just need to be aware of that, but that's what you just need to, kind of the simple decision that you need to make out. And Vincenzo talks about how could we identify at least some fake breakout. It's a very good point. What I would suggest, and it'd be easy maybe for me to show you on a chart in a few minutes' time, is what I'd be saying is, if I just clear my drawings here to help us, if you know, I'd be looking is, you know, if there's a false breakout here, well then, you know, what I'd be waiting for is to see, well, what is the price action like? Okay, if price tracks through but then gives me something like a reversal candle, like a pin bar here, then that gives me an indication that, okay, there's an increased likelihood that there is a false breakout. So I would be getting ready to maybe exit the trade early if I look at that, you know. And what you'll see is quite often, you know, that if there is going to be a false breakout, it's accompanied with, you know, suitable price action. Okay, suitable candlesticks, reversal candlesticks on that time frame, or maybe the one below. So you just might want to sort of take a moment to watch that, okay, to see if you get a break of the breakout of the inside bar, but then actually you get a reversal pattern, you know, something like maybe like a, you know, a pin bar or an engulfing candle in the opposite direction. Well, then that might give you an indication. Well, okay, hang on a minute, you know, this is a chance of a false breakout. So we'll have a little look at that as we go through a couple of the other charts there. But it's a good question, Vincenzo. Thanks very much. So, you know, as I said, you know, I particularly like to use them in trending markets, where I will look to use them as a continuation signal. And once again, it is effectively about using a confluence of events, all right? Ideally, we want to see them at, you know, forming at a support resistance levels, all right, as, you know, as part of the rest after a surge, okay, before we get the next surge again. That's what you're looking for. And some people will call that sort of, you know, an ABCD pattern, okay? As some people would want to call it that, okay. You once again, the name that the label that you give to it is not, you know, necessarily massively important. It's about actually more understanding the underlying price behavior. That's what's actually crucial to know, okay. Markets surge, then they rest, and then they surge again, and you're trying to position yourself to try and catch the next surge. That's what we're interested in. So, you know, here's an example, actually not from 2 weeks ago, earlier in the summer here. This is the daily chart of the euro yen. We can see that we're in a pretty significant, pretty strong downtrend, okay. It was basically, you know, we had Japanese yen strength, euro weakness. Price is actually moving down very, very nicely. And price then pulls back, okay. Price pulls back. It forms a, you know, a bit of a flag pattern, which is in itself continuation pattern, but we can see that, you know, prices moved its way back, and then it actually forms here an inside bar, okay, at the end of this pullback. That's what I was saying, remember? Surge, rest, and then surge again, okay? That's what we're looking for. That's what you're just trying to understand. That's what you're just trying to see within the markets, okay? So, you know, this happens, it will occur, and you just, you know, the case of, especially on the longer time frames, just being able to effectively just monitor for this as part of your trading routines, as part of your trading checklists. Undoubtedly, there are actually sort of EAs that you can get yourself hold of, okay, or indicators that you can get hold of for MT4 and MT5 that will alert you to inside bars. But I mean, if you're trading on the sort of, certainly on the longer time frames, daily, weekly, monthlies, it's a pretty visual setup. It's pretty simple to see and recognize, and it's not happening too fast. Yeah, and once again, this is the Aussie yen. Okay, we'd had a bit of a, it wasn't so particularly clear, and sometimes I like to show that, this was in a downtrend, but it wasn't a particularly pretty one, shall we say, ladies and gentlemen. All right, and that's if you've traded for a bit, you'll realise that invariably that's actually what happens. Is that price had having hit lows here, okay, it actually pulled back to the 20-period moving average, which was acting as dynamic resistance. Then it placed a small inside bar here before price traded down for the next few sessions. And as I said, that's what we're looking for, okay? Surge, rest, and then surge again, okay? And then we can see that actually price just, what happened here, price got down to these particular levels of support, down to these levels of support before starting to put in some inside bars here of its own, okay? So it was just a case of, quick move down over about 4 or 5 weeks, okay? But that's still, there's still a month of price tracking its way down into those levels of support, which provides with a trading opportunity. And here's another nice example of trading in a particular trend. Okay, this is a dollar yen. And price is in a downtrend. Okay, it's made it surge. It pulls back nicely. Pulls back to the sort of dynamic resistance of the 20-period moving average, and then what does it do? But it puts in an inside bar there, okay? And that's really the opportunity there for us, okay, to just position ourselves for the surge to re-exert itself, okay? The opportunity to sort of have our trade position to enter short beneath the break of the lows with our stop above the recent high or the high of the mother bar, the mother bar there, okay. But you can see that's a nice flag pattern as well, okay. So if you understand your price patterns, okay, that's a continuation pattern there. So gives us an opportunity to effectively to join what was to continue be quite a strong existing downtrend for about the next month or so, okay. So as I said, just keep an eye. You can add this to your particular trading watch list and trade them as they show up. So we've looked there as as I said, my preferred setup is using inside bars as part of a pullback, okay, in an existing trend, but they will also work in true breakouts. All right, okay. So what you're looking for in that particular case is you're waiting for the breakout to occur of a particular range or a level, and then you look for an inside bar to be printed afterwards. And then you're looking to sort of trade in the direction of that breakout. So, they do work and they are valid in terms of true breakouts. And sometimes, for intraday traders, that can be actually quite a useful way to sort of engage with markets. All right, if you don't want to buy or sell the actual breakout, giving you an opportunity to wait and see if there's an inside bar printed after the breakout provides an opportunity for you to sort of join with less. With a kind of a less aggressive entry for into that what might be the new trend. So what we can see here is that this is a bit of an example of sort of kind of a double whammy, so to speak. So price, this was the euro yen on the daily. Price is in a downtrend. Price pulls back. Okay, it hits the 20-period moving average, right? Then it prints an inside bar. Then it actually breaks out. It breaks the supporting trend line here, okay? And then after that supporting trend line, it actually puts in a couple of inside bars before it moves again to the downside. All right, so you've got a little bit of a combo there. All right, so the inside bar on the pullback, followed by a couple of inside bars on the breakout. Okay, on the next surge. So, as I said, it's if you're going to trade it as part of a breakout, here we've got, you can see that the price is in a range there. Okay, this is the 15-minute chart on the DAX. We can see that, it's just in a standard range. Price breaks out here. Then the next candle, okay, is it's a bit of an indecision candle, all right? But, what we're looking to do is, we've had a breakout to the south side. So what we're doing is we're expecting, okay, to be able to trade in the direction of the breakout. And that's just one simple way on an intraday basis to be able to sort of catch those trades and just sort of join the new breakout, in the hope that what we'll see is the next surge for that, let's say, for that intraday session in this particular case. And this is, sort of a bigger example here. This is gold. Okay, this is gold on the weekly chart. As I said, we're trying to share ideas that are instrument and time frame agnostic. We can see that actually this was what we had last year. Was that we had, for the first part of the year, price was just effectively in a zone of consolidation. Okay, there's a little bit of accumulation of sell orders going on here. Okay, it's just working its way back and forth. But once price broke out, okay, it broke out to the south side. Then actually what happened is we got a pair of inside bars here. Okay, the price is basically tightening up to get ready to make its next surge. And we're looking to trade in the direction of the breakout, and actually you can see that that was quite a significant move for us there, ladies and gentlemen. So for a breakout, regardless whether it's 5-minute or weekly chart, once you see prices broken out and close the other side, then if you see an inside bar printed, that gives you an opportunity to basically to trade in line with the new trend. So, how do you enter? How do you once you've seen this, how can you actually look to enter? And so today, we're just going to go what we'll call, could call a conservative entry, the sort of safe standard entry here. And so what we'd be looking for is, if, prices in this particular case has pulled back. So we'd be looking to trade on the break of the high or the low, which could be, 2 to 10 pips, depending on the direction, the time scale, and the spread. So what I always suggest is, if you're going to be a buyer, then invariably you're looking to sort of trade, or at least sort of on an intraday basis, probably 2 pips plus the spread on for a buy order. If it's on let's say a daily chart, well, you might be looking here at, let's say, 5 to 10 pips plus the spread. Okay, for a buy order. For a sell order, normally I just have a sort of 2 pips beneath the low of the candle. The stop loss, okay, the stop loss would be on the other side of the bar. And ideally, we're looking for a reward to risk of about 2 to 1, right? But it's it's the kind of safe standard entry, but it just normally require a good move to achieve that reward to risk. But that's what we're particularly looking for. Some people might like to sort of use that as an entry, but then instead of having a sort of a 2 to 1 target, they like to trail their stop loss. Okay, hoping that the trade might run and run. That's absolutely fine in terms of deciding whether you use a target or trailing stop loss. That is should be part of your trade plan. It should be something that is identified before the trade is even placed. Okay, that's the key thing. You don't sort of change horses mid-race. That's the key element. So, as I say, points to note is that, as we always say, no trading method is 100% accurate. Okay, if anybody tells you there is one, they're fibbing to you. Okay, so that's why it's important that you use stop losses and that you also utilize risk management. And those are sessions that you will find. There are quite a few sessions already in the Admiral Market, so webinar archive on the YouTube channel and Facebook page, but also will be covered in future trading spotlight sessions as well. As I said, with inside bars, you just need to be aware of a false breakout. Okay, and as I said, if there is a false breakout occurring, when you see let's say the existing inside bar breakout, have a look at how the price action gets formed around that breakout. If it's showing you reversal patterns, it could be that it's a false breakout and you may wish to leave early. Just keep an eye on that particular trade. So, that's why we're always looking to either trade them as either at the end of a pullback in a trend, okay, ideally, or after a very clear breakout. Okay, it should be a very clear move. And that is what helps minimize false breakouts for ourselves. So to finish up, ladies and gentlemen, all right, okay, the inside bar, it's a simple technical setup. As I say, it can be used across all time frames and instruments, regardless of what you particularly choose to trade on. It can be used for reversals and also for continuations. Personally, as I say, I like to use it as the end of a pullback in an existing trend, but it can be equally well used for either a reversal or for a breakout. Just be aware of false breakouts, okay? And what we'll do is maybe we'll have a little look to see if we've got a few minutes that we could just finish out checking out a few that may have set up today on live markets. So, you know, I hope you found that useful and interesting, give you a little bit of insight and something that you can share with you. As always, you know, don't forget to join us next time. So, you know, we have on Wednesday, okay, here we've got my colleague Marcus Gable is going to talk about beginner's guide to creating a trading strategy for yourself, and that's going to include how to use the KISS principle applying to your trading, an introduction to Dow theory in the modern age, give you some sort of live market examples, and that will that's going to be on Wednesday, okay, 1 p.m. UK time, okay, GMT time, so it'll be like 2 p.m. Central European time. If you just check and sign up on the Admiral Markets education page on the Admiral Markets website, then you'll get a reminder that event is going on. So, as I said, you can check your inbox for the webinar link, and you know, as always, this session and others, you'll be able to watch them on the educational webinars on YouTube. So please feel free to sort of register and join us for Marcus' session on Wednesday. As always, you know, there's plenty of analysis and education. You can go to admiralmarkets.com. If you're looking there, there's a wealth, okay, actually wealth of tools and resources that you can utilize to help you with your trading. As always, if you have any questions, you know, during or after the session, you can get in touch with us by emailing at hello@admiralmarkets.com, or YouTube channel, youtube.com/admiralmarkets, and facebook.com/admiralmarketsglobal. And as I said, you know, if you'll just bear with us a moment, what we'll do is, you know, we've got a few minutes left, so we'll switch across to the live charts, have just a quick look at some examples on sort of sterling pairs this morning. Vincenzo says thanks to you and Admiral Markets for an interesting webinar. That's great, Vincenzo. Thank you very much for joining us. Okay, really appreciate you coming in and asking questions. We really appreciate that. So if you just bear with me one moment, I'm just going to try and switch across to the charts, and we can have a few minutes there looking at some possible examples there. So here we go. This is the Admiral Markets MT4 Supreme edition. That hopefully you can still hear my voice, see me, see my screens. That's always a good sign for us, ladies and gentlemen. All right. So let's have a little look at what we've kind of got examples of here today. So this is just a profile for sterling pairs. Okay. So let's have a look at something like pound yen. Well, let's have a look and see if there's a couple of examples here that just show you different time frames. And this is the monthly chart. Okay, this is you know, it's a big old chart here. Okay, and you know, it's perfectly possible to look for inside bars here. Okay, on the monthly chart. Okay, you know, it won't happen very often, but when they do, they can well be most definitely a useful sort of addition. And we can see here that, you know, if we just get the drawing tool as always, you know, price throughout 2018 was kind of drifting down. Some of you may remember at the end of last year, start of this year, we had a little bit of a flash crash, okay, there on some of the Aussie and yen pairs, and price actually sort of drifted back up. Okay, price pulled back up to the blue 20-period moving average, you know, and once we were there, well, you know, we printed an inside bar here. Okay, we can see that you know, just the 20-period moving average acted as dynamic resistance. Okay, it was just higher than the bar before it, the preceding bar. That gives us an inside bar, and then, you know, as usual, as I said, we're looking for the surge, then the rest, then the surge again. And you can see here again the monthly candle that actually, once we broke the lows of that, will then invariably, you know, for the last, you know, in fact, pretty much for 2019 since then, we've actually just been in a drifting downturn there, okay, on the pound against the yen. And, you know, that's what we've got there is you've got a great example of, you know, a technical picture also colliding with the fundamental picture, in terms of the Japanese yen has been very strong because of, actually global economic sort of fears. We've also, sterling has had weakness because of sort of Brexit shenanigans that continue to go on. So you just had a technical setup there that's been backed up by the sort of the fundamental and the sort of geopolitical and the sentiment picture that has built. So, as I said, these show up across all time frames. It's about just being able to recognize them and add them to your own particular sort of trading inventory. So if we have, that was the pound against yen. If I have a look at, let's look at some of the others here. Let's go to the other end of the spectrum with the pound against the Canadian dollar here. Let's just move this out of the way so we can have a little look here. So, here we had, from this morning. This is the pound against Canadian dollar. It's a 5-minute chart. We've gone absolutely to the other end of the spectrum here, and what we've had is we've had a real big sell-off in sterling there. You can see it yourself in the 5-minute chart, and then what actually happens is, once again, price pulls back here. This is just a 13-period moving average. Price pulls back to it, okay, and it's halted there. So we've got we're in a downtrend. We've had a pullback, followed by, what do we have here? But we have a nice little inside bar here on the 5-minute chart, which is also a little bit of a spinning top, okay, a little bit of indecision after the move up, and then we can actually see that price sort of drifted its way, continued to drift its way down for about the hour or so afterwards, okay, just an hour and a little bit overwards there, okay, and it just drifted its way down there. So once again, as I said, that was an example of you've been able to sort of join an existing trend on the the surge, then the rest, then the surge again. That's really all we're looking to do. It's also a little bit of a 3-bar reversal. That's a nice simple setup there, okay, that we've covered in other webinars as well. So it just gives you a little bit of an insight into how, even on an intraday basis, these kind of opportunities will set up for you. Let's have a look at the. Let's have a look at on an intraday basis. Let's have a look at the pound against the New Zealand dollar here. Let's just zoom in. I just need to move this so we can see ourselves what we're doing properly. And actually, what we had here, I'm just going to zoom in a little bit here. Hopefully, that will help us a little bit more. And what we had here is, let's just get the cursors up. This was just the Asian session here. Price had made a false breakout, okay, this morning. Okay, it looked as if it was going to go up, and then actually put in a reversal pattern there. That is a morning star formation, sort of, big body bullish candle, followed by a reversal candle, then, finished off with a strong bearish candle. So that is, a morning star formation. But actually, if you look at what happens next, is that next we get a bit of a, sort of a bearish rejection candle there, which also happens to be an inside bar, okay? Also happens to be an inside bar. Prices made a bit of a false breakout, okay? All right, it's a false breakout, it's failed, then actually prints, an inside bar, and then actually price falls away, okay? Price falls away, and actually what we can see is that price falls away, it then pulls back and presents us with another inside bar here, okay? This is another inside bar here, which is 3-bar reversal. It's a bit scruffy. Then actually price starts to drift away again. So just so you can hopefully just recognize that. You can see that there's just 2 types of inside bars, but it's about recognizing the context within which they occur. That's the key thing, ladies and gentlemen. Okay, recognizing the kind of context. It's not about sort of just looking for an inside bar and just trading it. Okay, it is about what is the context within which it is actually appearing. That becomes absolutely key to us. And let's finish off the last minute or two with pound against Swiss franc. Okay, we're on this is the 4-hour chart. So I thought this would show you a little bit interesting. Just it's not perfect. It just shows you how markets can be a little bit scruffy. Okay, so actually price had been in a bit of a downtrend here. Let me just put the cursor. Price had been in a bit of a downtrend. All right, pulled back, puts in a little inside bar here before it falls away. Continued by more inside bars. But then actually it puts in quite a double bottom, a reversal pattern there. Okay, it's not a particularly pretty one, not particularly sort of a picture perfect one. But then if you've traded markets long enough, you'll know it really is picture perfect. But there is definitely a double bottom there, which is also completed with a big key reversal candle, bullish engulfing candle. And then actually what we see is price, starts to settle. It settles into, there's an inside bar. Okay, we've tried a little bit of a surge. It's having inside bars, and actually what we can see is that the inside bars just forming. The 20 period moving average has gone from acting as dynamic resistance to dynamic support. We can see there's inside bars, which is just showing us that the price is just, we've had a surge, now it's had the rest, and then what do you know, we get our next surge again, and you can see that the price surges up from there. So there you go, ladies and gentlemen. Just try to show you a few different examples there. Okay, a few let's say nice clean setups, but also just being able to see that I appreciate sometimes charts aren't pretty. Okay, and you have to be able to trade what you see, and it's about being able to recognize inside bars and also recognize the context within which that they are occurring. So I hope you found that useful. I hope you found that interesting. I hope it's given you something that you can sort of take away and utilize in your own trading. As I said, if you have any particular questions or interest, by all means, feel free to shoot them across, and also be aware of registering for Marcus's webinar on Wednesday afternoon. And I'll look forward to speaking to you next Monday, ladies and gentlemen. I hope you have a great trading week, and I look forward to catching up with you soon. Many thanks.